Hello, this is Noshi. How are you? Can you hear me? Let me check. Can you hear me? Yes. Can you type in the message? Can you hear me? So this webinar is being recorded, and if you want to get the recording, you can send me email, and I will share the link with you. So as discussed, we will analyze in the coming week's talks. There are about 24 symbols, and we will also discuss 4. And I will give you the support and resistance levels and tell you what happened on Friday and what should we expect coming week. So when I was starting my career about 10, 12 years ago, I had a mentor named Chief, and Chief told me, Noshi, you need to learn how professionals make money in the stock market. You need to understand when they come and when they exit. So if you can recognize that, you will be ahead of the crowd because sometimes they are, but sometimes they are very quiet. You have to understand when they are coming and when they are exiting. So I'll show you the NVDA chart, what I saw before it tanked last week. Huge money in NVDA puts. Notice that NVDA has topped out, and because he bought it. And also what Bruce Lee has told us, that I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So what it means is we just need to master a few techniques, a few patterns, and then just keep focus during the day on those patterns. And when the stocks shows that pattern or the kind of move you are looking for, then you just ignore the noise, just ignore the whole market. There are the 8,000 stocks, so you cannot focus on few stocks. So it's better that you prepare one night before. When the stocks move, you know what's happening. So it's better to prepare overnight. So I do prepare, and I make a list of 20, 24 stocks which I would take action right away in early morning or during the day. Some stocks I prepare during the day when they are moving. I make a list on my watch list and ignore some, add some, delete some. Then at the end of the day, then I go over okay, what's going on, what happened, are they worth watching next day? So I just follow a few techniques, and we need to master the produces high and fast return. So sometimes we get stuck in the stock which are not moving, right? And if you have option, then that's a bigger problem. So we need to find those stocks which are about to move, make a big move, and especially if you are trading, the return is. We are basically swing trader, so we do swing trading, and swing trading means the holding period is between 1 to 7 days, ideal. So it's investing and long-term trading. So we know investing, you buy and you hold, you buy based on the fundamentals. You expect the stock will make a move in 6 year, usually in the retirement account, and then you just forget. Day trading, where you buy and sell the same day, you must go in cash during the same day. So that's day trading. In between is there's a position trading also, where you hold for a few weeks, and then after day trading, swing trading, where you hold between 1 and 7 days. So it combines the concept of investing and day trading. Objectives of swing trading, the option with it then you are trying to maximize the profits in short period of time. So you expect the stock to move 3%, 5%, 7% in a week, minimum 3%. So if you take 3%, then the option can move 40, 50%. So your risk is only via option premium. So that is your risk. You can lose all. If you buy a contract for $200, you can lose all $200. So that's the minimum risk, or you can lose $150, 75% profit loss. So, but you won't lose more than that. Okay, next. So yeah, this is what we are talking about, return via swing trading. Return via swing trading, stock is 3 to 7%. If you combine, if you are trading options on that move, it becomes 40% to 100%. So that's a big move. Now the tools, so the swing trader tools. The tools we have, you don't need a perfect indicator. I don't have any indicator. I used to have like MACD, Arun, DMI, all this ADX, all those indicators, but I don't use anymore. So I'm a pure price. So I only watch the price move, and then I look at the volume. So only that. I don't have any indicator on my chart. So I make it very well. So there's no indicator on my chart. All right. So I identify the proven pattern and I execute the same techniques daily. So you need to execute, you just master a few techniques and then you just trade those techniques. Like for instance, if I'm learning to cook Thai dishes, so I would go to school and I will ask, suppose the teacher, okay, I just want to learn 5 dishes, the main 5 dishes, and I will taste it, I will like it, I will say, okay, yeah, these are the 5 dishes, yummy, and I want to learn to cook Thai dishes. That's it. I don't want to master like 50 dishes. Fine. Yeah, if mother, she can cook hundreds of dishes, not Thai, but our own dishes. So she has done it for whole life. So, but if I'm cooking, I only follow 5, 6 dishes and I keep just cooking and I like it. So same thing, when I'm trading, I only use the same techniques again and again. So if the stock comes in, I know it will do like that. And I use my judgment, my previous experience, my skills, and there is a flexibility. So trader need to be flexible, need to understand the broader markets and indices, what they are doing, and then um, trade accordingly. So let's say the stock market is going down during the day. So if you understand where the support is and the support is approaching um, during the day, suppose you know that, okay, after 1 hour or 2 hour, the indices will hit the support. So it's not a good idea to short or go for a stock which is going down unless you are quite sure that the stock will still go down even if the market will bounce back. You have to be patient. Let the market hit the support, and then as soon as they hit the support, then you have your list, and then you go long on a certain stock. So let's say the stock is coming, market is coming down, all 4 indices, and then you identify, okay, NASDAQ is the one which is hitting the support and reversing to the upside. So what is stocks on the NASDAQ? So if you know what is stocks, or if you're whatever you platform you're following, if it tells you, okay, these are the stocks which are hitting the support. So the good thing is, ideally, when the market is hitting the support, the stock which is in that market is also hitting. These two things coincide, then it's a better entry. It's a low risk entry to go long on that stock. And during the day or when you are putting the trade, you need to stack your probability in your favor. So you stack your probability in your favor and let the trade do its thing, let the stock do its thing. So that's what the probability You need to stack your probability. You cannot be 100% sure. If you're 100% sure, then you can just buy tons of shares or options. So as long as you stack your probability in your favor, you just go long in that stock or go short. So the uniqueness of swing trading is the easiest trade comes before crowd notice. You need to identify the move before the move is happening, so that when the move happens, you make big bucks. And fortune is made by a single. So a lot of traders in options, they go for a big move, 100% gain, 200. It's easy to get 100 and 200% gain. It's easy to make 30%, 40%, 50%. And then if you keep rotating it, then it adds up. So compounding effect takes place. And the home run, once in a while, you hit a home run that takes care of 2-3 losses, and you have a smooth and rising equity curve. So we have a swing option trading. In case you're not a member, I see a lot of people, of you are not my members yet. So let me go through briefly. So I provide alerts during the day. So you receive email, you receive a special. So there's a buy price I give. Sometimes I give you the range, and I will explain what happens when the stock is moving and what to do. So I will explain in the next slide. I provide three, call them green, yellow, and red. I do explain what to do in green, yellow, and red in another presentation I did last time. I do provide a guidebook. So in the guidebook, it is explained what to do when the stock is hitting the top. I call it green, yellow, and red. Technical analysis via charts. I show you via webinar. I show you in the Facebook group. So I regularly post in the Facebook group. If you are not a member, you join the Facebook group, and I do post at least one chart a day, maybe 2, 3, sometimes a lot, and sometimes like 20. I will show you 24 charts today. So weekly, I show you the technical analysis. So webinar analysis, guidebook, all real-time trade alerts. So benefit is there's no shortage of the trade. I provide a lot of trades, and I try to educate you, and I educate myself every day. I educate myself, something I learn new, and the questions I receive, the knowledge the members share also increase my knowledge. So that's the benefit. And this is some of the testing I receive. I receive so many. I compile. Sometimes I just file them. So these are some of the testimonials you can read. These are some. All right. So next slide. Okay. So I'll explain to you what I do during the day. I have explained many times before. So if you have heard this before, sorry, you have to hear it again. So there are various strategies. So one of the strategy I like, breakout strategy. So breakout strategy means breaking out, either breaking out, making a new high, or breaking out of the consolidation. Sometimes the new high keeps going up and up. So you have to understand if it's not. So if you can determine the stock is not overbought, and if you can figure it out the target when it's making a new high or breaking the resistance, then it's usually I like this strategy when the stock is making breaking out above the resistance or consolidation range. Yeah, my voice is, I'm sorry about that. I couldn't fix it. I contacted GoToWebinar, they couldn't fix it. Something to do with my mic, and this is my new laptop. So sorry about that, but I'll get it fixed. So the breakout strategy, again, when the stock is breaking above the consolidation range, and you will see the stock is trading in a range like 10, 15 days, consolidating up and down, up and down, and up and down, and then boom, it gaps up, and then furiously it moves upward. I'll show you the Twitter chart. So Twitter chart, I think Twitter was trying to break out Friday, and Netflix, two of them. So that's breakout. Breakout reversal, part of KSS. So this I call it breakout reversal. Pulls back. Is it due to earnings or some news to certain support level? So magically, there is the algorithm. Strongly believe that there is an algorithm. Otherwise, it's not just possible for human to act upon it so fast. So I spotted KSS. It was coming down due to earning, and then from a major support, it reversed the upside. So I'll show you the chart. And there was another stock, Kellogg. So the stock pulls back to some support. It pulls back furiously and then it reverses upward furiously. So this is very good move. When the stock just moves, all the people who are shorting, they get caught because the stock's intraday breaks certain moving. Something happens, 50-day moving average break or 200 days. So all those traders, they think, okay, this is confirmed, it will break, because they were waiting for the moving average to break and it broke. So they go for the short, more short. But then the buyers take over and they reverse. So when work, the sellers, they realize that they're losing the ground. So they try to cover, which fuels the rally. Then they become the buyer. So they reverse their position. And then when you adds up all this, the stock takes off. So this is what happened, I think, KSS. So I'll show you the chart. Opening range, again, I'll explain to you briefly. Opening range means there are like 8,000 stocks. I have 603 in my basket. We cannot watch all 603 stocks, which one are moving up, which are moving down. So I have set up a window of 5-minute, 15-minute, 30-minute interval, and 60-minute interval. So on one monitor, there are 4 windows. The stock doesn't show up on a 5-minute interval window. So there are 8 windows. So 4 for long, short. So my monitor, like 27-inch, I've set up 8 windows, 4 for long, 4 for short, 5, 15, 30 an hour. So as the stock market moves, the stock which are making intraday high during the first, after 5 minutes, they are still moving, they show up on the 5-minute window. And the stock which are moving down, they show up on the 5-minute window. So before 5-minute window, 5-minute, there is nothing on the on those windows. There's nothing going on. I don't see anything. Then after 5 minutes, the stock moves up and down, up and down. There are some stocks which will move after 15 minutes. So they will show up, right? So they will show up. We will see those stocks. So I say, okay, these stocks are still moving. 50 in out of 7 which were moving in 5 minutes interval, even 15 minutes past, they are still moving, 2 or 3 of them. So I start paying attention, and then so on, 30-minute window, and finally 60-minute window. So sometimes they just disappear, they come back because they are trading below the 15-minute high, mid high, right? So I notice, I put it on my chart, where was the high, 15-minute high, and then if it pulls back and then goes up, then I take the entry. So I combine all 5, 15, 30, and 60-minute windows and trade like that. So that's opening range breakout. It is explained in the guidebook. This is also explained in the which you receive, one of the strategy. So it's, keep an eye on the email. You would receive this strategy. All this is via email. So next is gap up reversal, gap down reversal. I'll go briefly. Gap up means the stock gaps up. So a gap down means the stock opens lower than what it closed before. Gap up means the stock opens higher than what it closed yesterday. So a lot of stock gap up, a lot of stock gaps down. Then some stocks gap up are meaningful, some are insignificant. Most of them gaps up, some of them gap down. So it happens all day, every day. But there are some gaps you need to pay attention whether the gap is taking place at the bottom, from the consolidation, or the gap is happening in the middle of the trading range, or the gap is happening right at the top, and maybe the dog will exhaust itself after gapping up. So you have to pay attention where this above resistance, below resistance, how far from the resistance. If it is gapping up way above the resistance, then you have to that resistance will become support. So if the stock has gap up way above the resistance, then it can pull back, and the pullback can be. So all this you need to pay attention. Sometimes the stock gaps up worse sharply because what happened, there is no volume. So some retail buyers, they buy it, they get excited, they buy, they take the stock to a new level, but it gaps up to the resistance and then it pulls back. There's no buyer left. So a lot of that gap, they buy puts or short. So gap down reversal, this is what I like. Sometimes the stock gaps down and then it reverses upward. Most of the time is because of the news, some negative news, earning. But when the regular session opens, so it's gapping down during the pre-market session. And when the regular session opens, it gaps down, but then other traders take over and they start buying it. So when they start buying it, the stock reverses sharply. So most of the gap down to 200-day moving average plays the role. So you have to watch the gap down. I do have a $17 offer. If you are interested, send me email and I'll give you the $17 offer for 2 weeks. It's only for new members, not for existing members. All right, and I have a 60-minute strategy session. I have a 6-month coaching program. So if you're interested, send me email and we can meet. It used to be 25 minutes, then it went to 45 minutes. Now I realize that I keep talking 60 minutes, sometime 1.5 hours. So during our meeting, so it's one-to-one. So I set it up for 60 minutes. So usually it goes for 60 minutes most of the time. So when we meet, like suppose we meet 7 Pacific time, it will go on till 8, 8:15, 8:30. So we keep talking. All right. Okay, let me open another presentation. This one. So let me explain some concepts. So I received too many emails about option selection. How do you select the options? Why you select this option now, and sometimes you select that option. So what is going on? So I don't know about, but this is what I based on. So option selection is based on these criteria. One of these criteria takes role. So the projected target. So let me explain. So when suppose I spot a stock which is bullish, right? And the projected target is, let's say, 65. So let me give you an example. It's 65 and it's trading at 61. So if it's trading and the target is 65, so I have a choice. I can buy 60 strike calls, right? I can buy 62.50, buy 65. So I have like 3 choices. 60, which is in the money, 62.50 is slightly out of the money, and 65 is way out of the money. And 65 is my target. So which one I will choose? Okay, so I can choose 65 if, and the stock is trading at 61. Only if I know the move is furious. There's a big major news and the stock should hit 65 in a couple of days. So if that is the case and the stock is trading at 61, I will buy 65 strike because that's where I will make most of my return. So I would take 65 strike. But if the stock is not expecting to hit 65 fast and the stock is trading at 61, I may go for 62.50 strike. It's slightly out of the money, and I expect that the stock will go above 62.50 quickly. So the strike will be in the money fast. So that's criteria for 62.50 strike. I may choose 60 strike just to be safe. If I choose 60, is in the money, time decay will be less, and let the stock do its thing, go towards 65 slowly and surely. So that's where I will choose the 60 strike. Current price and strike relationship. What I explained also to you, current price and strike. So where, so for instance, current price and the strike. So let me give you another example. If the stock is trading at, suppose, 72, okay, and they're only 70 and 75. So there are two strikes, 70 and 75. And stock is trading at 72. There's no 72.50. So what I would do, if I choose 75 strike and the stock is trading at 72, this is way out of the money, three points. So if the stock doesn't move fast, I would, and it takes time, I would still lose money if I choose 5 strike. So I would not go for 75. I will choose just a strike of 20. So that's where we have to be careful. What is the strike and where is the stop? The spread. Sometimes I want to choose a certain strike, but the spread is huge. For some reason, the spread is huge. It's ideally the spread should be 5%. The spread should be 5% between ask and bid. Sometimes the spread is like 20%, 30% in the strike I want to choose. So I say, okay, I don't want to choose that strike. I need to select the one where the spread is like 5%. So if the ask is 2, the bid is $1.90. The bid cannot be like $1.50. So if the bid is $1.50, what if I get stuck? So if I have to liquidate right away, then I will lose like 25%. So we have to think, what if we have to liquidate the position right away, right now? As soon as we buy, we want to get rid of it. If we buy a 2 and immediately we need to get rid of it, suppose for some reason we have to sell it at $1.50, that's not a good deal. But if we buy a 2 and we can sell it at $1.95 or $1.90, okay, that's okay. Another criteria is the volume. So if the volume is high on certain strikes, then that's the strike. There's a liquidity there. Sometimes you volume in many strikes. If you see the volume in way out of the money strike, then trader is expecting that the stock will hit that strike. But we have to think also that majority of the traders are wrong. So don't just take the volume as a criteria. You have to do your own analysis on stock and then decide. Don't just decide on the volume on certain strike. I've seen so many times the volume is certain strike and the stock never moves to that strike, and all those traders lose the money. Another thing is theoretical value and ask. So based on the formula, there is a value for the option, and the price should be ask should match that theoretical value. If it's way beyond, then just ignore that strike also. Another thing is the market condition. So if the market condition is super bullish, then your stock will move also bullishly, right? So if that's the case, it would be okay to trade buy out of the money strike. You can buy one or two strike out of the money. But if the market is choppy, and your stock will move choppily, then you need to buy in the money strike. Out of the money will waste your time and value, and your portfolio will suffer. And the last thing is the open position. So if you have many positions open, then you have to be conservative and go for the in the money strike. So these are the criteria. So when the trade triggers through the stock, then comes the option, and then go through this criteria to select. All right. So sometimes when we sell the when we send the alert, sometimes if you remember, you notice the stock is moving aggressively, and here comes the alert. So here comes the alert, buy this at this price, and the stock is moving. I couldn't send fast enough. Like I wish they, and then the order is executed, but it doesn't happen. The email takes at least 15 seconds. Sometimes it's 5 seconds, but 15 seconds, 30 seconds to reach. So minimum I've noticed like 10 to 15 seconds. So the email goes through and you receive the alert. So when you receive the alert, pay attention to the target. So if the target is huge, so suppose let's say the stock is trading at 70 and the target is mentioned at 78. So there is an 8-point move. You receive the alert. So it's okay to buy, pay a little higher price than what is mentioned in the email, because the target is huge. You will still make money. So you will make less money than the person who bought earlier than you, but you would. Sometimes you make more money. There are many scenarios. So you need to buy, but don't buy. Like sometimes I receive emails. Suppose we bought the option and it's trading at 3, and I send the update that it's looking good. The stock is moving in our favor, and then I receive the email. Is it okay to buy? Can I buy now? So the that trader, that member did not check that we send the alert at 2. It's trading at 3. If you buy at 3, you're buying at 50% premium. What if I sell at 280? I will say trade close. We made 80 cents. And then you say, what? I lost 20 cents. So you have to pay attention to that. If you cannot chase by a long call, you can always create a vertical spread. So vertical spread is explained in another presentation. Basically, you are buying one long call and then selling another short strike against it. So you minimize that risk of the huge move which is happening. But you know that, okay, eventually the stock will go towards the target, which is way above. So you can create a vertical call spread. So this is what I tried to explain. Now, this is a little chart I explained to you, and it pays attention. So when the alert is sent, people, traders say, okay, can I pay more? So yes, you can pay more. So this is the guideline. You can pay more, and the reason you can pay more because the target is huge. So if the target is huge and the option is trading in this range, you will make money. So you just don't say, okay, I missed it because the alert was sent at 70 cents and it's trading at 75, so I would get it at 70 cents. What you can do is, if the alert is sent at 70, you can set some buy order at 70 cents, and if it's trading at 75 cents, 77 cents, you buy some at 77 cents. So you don't buy all at the higher price. You just buy a little bit in case the stock keeps moving. You are in the trade. If the stock pulls back, you can buy more later at the reduced price. So this is the chart. It's explained in the guidebook. You receive email also. Here it is explained in the chart. Next, limit orders. So when you set the alert the order to buy, suppose the option at $2, then you need to pay attention to what is happening to your limit order. Don't walk away from your computer, leave your desk until you see your order get filled, because you may get hurt. So I'll explain why. So watch your limit order, see what's happening, watch the option chain, what is happening, and build, and then you can leave your desk. And do not buy at market price. It's very risky to buy the market price. You can get the worst fill. So unless the stock is moving huge and the spread is not that wide, and you're not sure, when you set the order for 4, it goes to 420, then you try to chase at 420, it goes 430. So, and you want to get in, but you know the spread is normal, then maybe you can put it at the market price. Otherwise, change your order. Suppose you set it at 4, it's trading at 420. You set the limit order at 420, but sometimes what happens, you set it at 420, it goes to 430. Then you set it at 430, it goes to 440. So you just keep chasing and chasing and chasing. So don't do that. Just set it at 420 and leave it. What will happen? The stock will trade in a range, and then eventually your order will get filled. So do not try to chase it. Do not buy at market price, and the stock should be trading in a range. So when you are trying to get your order filled, and pay attention to the yellow target. So whenever you are, by yellow target means whenever you are analyzing your own stock, so you see, okay, where is the target? If the target is huge and you will still make money even if you pay 20-30 cents, then you can go ahead and pay extra. Otherwise, if the target is closer, then don't pay. Just be patient and try to shave the spread. So if the spread is huge and you know the stock is moving, like the spread is not normal. It's supposed to be 10 cents, it's like 30 cents. So you try to shave the spread. So the spread is 30 cents. Don't try to settle in the middle. You will not get it. So let's say the ask is at 430 and the bid is 4. If you try to buy at 410, you will not get it. 420, you will get the order because somebody wants to sell at 4 and somebody wants to buy at 4. So you will get filled at 420. So pay attention. Don't leave your desk before your order gets filled. Next one is handling partial execution. You set the order to buy at 10 contracts and you got filled only 5 at your limit price. So if you got filled at 5, don't try to chase the rest of the 10 at the higher price. Be patient. Leave your other 10 contracts at your bid price. If worst comes worst, you miss it, right? So the stock goes up, keep going, and you make money only on the 5 contract. But most of the time, the stock will come down, and you will get filled at the remaining contract. So someone will, and especially if the stock is trading in a range. So if the stock is trading in a range, like 30-40 cents range, eventually it will come down and you will get filled. So be patient. And if suppose the stock doesn't get, your orders doesn't get filled after 5 minutes, 10 minutes pass, then just cancel it. You can always set the order again. Don't just leave it open because the stock can reverse shot. So if you leave your order open and you didn't get filled and you walk away, you may get filled and the stock is tanking. So don't do that. You can cancel your limit order. You can always set your order again to buy. So cancel the remaining contract. And buy order is only good for few minutes. It's not valid for more than 5-10 minutes. It's not valid after GTC, like good till cancel. Don't do that. If you set GTC, if you get filled tomorrow and down, you will lose money right away. And next is when and how to exit. So there are various criteria. After you get filled, there are various criteria of getting filled, locking the gain. So the most common is based on the profit objective. So traders say, okay, I want to make 40%. So if you want to make 40% on the trade, if there is no meat in it, if there is no potential of 40%, then you will never make 40%. You may make 30%. Your contract will go, option will go to 35% profit, and then it pulls back. So you never make 40% profit. So so it has flaws. But on average, suppose the trade, based on the history, that you make 40% profit. So if you have 10 contracts, you say, okay, on average, I make 40%. So it's good to set the order for 8 contracts at 40% profit. You can set the sell order good till cancel at 40%. So for example, if you bought at 4, you can set at 560 immediately. So that's very simple, locking the gains at 40%. So at 40%, if it hits, you make $1.60 per contract. So based on the profit objective, but it has flaws. So you have to know the flaws. It can go all the way only 35% profit, 39%, and then it never comes back. So this bid can hit 550 and that's it. It comes down. You never get filled at 560 because the stock didn't move enough. So your order will remain open. Okay, so you have to know that it has its flaw. So you have to be conservative in your estimation when you are setting up the target. Like now, another way of setting your sell order is based on the option target price. So let's say you bought the option for $4. And in the alert, I don't provide this. I hardly say option target price is 510. I don't do that. I provide you the stock target. But let's say I send you the alert, say, okay, buy at 4 and sell at 510. Then you set at 510. And another way of determining 510 price is through the formula. A lot of platforms have formula where you plug in your option data like month and strike, and you put your estimated target for the stock, and then the platform will tell you what would be the option price when the stock hits your target. So that's also estimated, and you have to once you get that price, you have to subtract the spread because it's giving you the ask value, and you have to be conservative. So whatever, so let's say it gives you based on your would be trading at $5.40. So you say, okay, I'll set it at 510 and I'll see what the stock is doing and I will adjust the price later. So in the beginning, you be conservative, set it at 510. So that's based on option target price. All right. The next way of selling your contract is based on the stock target price. This is what I follow. So when I send alert, I say, okay, buy this stock at this price. I mean, this option at this price. And the targets are these green, yellow, and red. There are 3 targets. So what I expect is when the stock hits the target, then sell the option, whatever is the price of the option. So for give you example, let's say the stock price at the time of buy is $63, right? So we executed the option, we bought the option, and the target given is $65.40. So there is a $2.40 move in this stock. So $2.40 move in the stock will result, suppose $1 move in the option. So option we bought at $4. We don't know what would be the option price when the stock hits $65. So what we do, if we are monitoring our stock, monitoring the trade, whenever the stock hits 65.40, we sell our option, whatever is the option price at that time. It could be 480, whatever it is, we try to shave the spread and sell it. If not, take the bid, sell it, and get rid of it at 65.40. So that's when we are monitoring our position. Now, there is one very simple way and efficient way of selling it is through conditional order. So if you set it through conditional order, you don't have to monitor your trade. You can be away from your desk. So I discovered conditional order when I had a consulting job and I was busy with my consulting work, and I was said, okay, how do I set this order when I'm not there? The order gets executed. So then I learned about conditional order. So I explained conditional order in detail in another presentation, but I'll explain a little bit here. So setting the conditional order to sell all contracts at 65.40. Basically, what you're doing it on your platform, you're telling your platform that, okay, I have this option, sell my option at the market price when the stock hits $65.40. So whenever the stock hits 65.40, all my contracts are sold. So in other words, you don't have to watch your position. Okay, what would be the option price? What is the stock is doing? Is it at 65? Is it 65, 40, 65, 60? But if the stock hits 65.40, you will be liquidated. The only drawback is if the stock hits 65.35, your order will not be executed. Even at 65.39, your order will be open. So you then if you're trading options, you have to monitor it at least once a day. So but this is the efficient way of doing. Suppose you have 10 positions, you set all your all orders conditional order, and let the market take you out. So you don't have to watch individual position. Especially this works when suppose you have so many positions open and the market is bullish, you don't know what's going on. This when this will hit, when that will hit, bam bam, you don't know. So you just set the conditional order. Like I have a client who is a doctor. So one day he sent me email. He said, I came to my office and I saw this, bang this, bang that, sell this, sell that. So all my position was no longer open. So what happened? So he realized, oh, he has set the conditional order. So all were liquidated while he was busy seeing his client, his patients. So it works. So that's one way of exiting conditional order. This is very important. The next is the times limit sell order. So let's say there has to be a time limit. So let's say your position is still open for 14 days past, 20 days past, and not moving. You may want to liquidate that position and move on to another position. So just don't keep holding it, because time limit. So you can decide yourself. Okay, I have a limit of 10, 14 days. If 14 days pass and my position is still open, I'll liquidate it. And then the last one is market conditions. So it doesn't matter what happened. If the market is crashing, then it would be a good idea to liquidate your long positions, because all stocks suffer. So that's the last criteria of liquidating your long position. So let me recap. I'll prepare the slide recapping. We talked about how the options are selected, how I select, and how you should be selecting, and what to do when the stock is moving aggressively, how much to chase or not to chase, how much to pay, when to pay 5 cents, 10, 15, 20, 30, 40, 50 cents extra. So for example, if the option is trading at $12 or $13, 50 cents is nothing to pay extra. The reason is the options are expensive. You have to know that the option is expensive because the stock ATR is high. The stock is crazy, is volatile, is like Netflix, is like Baidu, Google. They are the one which moves like $10, $15 in a day. So for $12 option, 50 cents extra is nothing. But for a $1 option, 50 cents is too much. So for $1 option, you can pay only 5 cents, 10 cents. But for a $12 option, $18 option, you can pay 50 cents, 80 cents, 70 cents extra, because you will make money. The stock will move $10, you will make $400, $500 per contract. So you have to be, this is where I explained to you being flexible. So flexible. If you just make one rule, okay, I only want to pay 20 cents, it's not going to work. If you want to pay 20 cents extra for a $20 option, it's nothing. The spread itself is 80 cents, 90 cents. So you have to change your rule. Then we explain limit order, right? So we talk about limit order, when to set the limit order, what to do. Partial execution, what we should be doing on partial execution. Sometimes you get filled only like 2 contracts and you set the order for 20. So what to do with the other 18? And we talk about 5 ways of exiting. So profit objective, based on profit objective, based on option, based on target price, then time limit, and then the market conditions. So we covered this area. Now I will show you the chart. So it's 5:50 now, and we'll go another 25 minutes. So let me explain the charts. All right. So ANF. So I found ANF on Friday, and it's sitting at 50-day moving average. So when I see the stock like that, I just make a list and watch list. So this is like on my watch list. ANF is sitting on 50-day moving average, so I know 50-day moving average is the support. So I just keep it on my radar, and if I see the move, then I go long. If it If it breaks below, then my exit. Sometimes there is a break intraday. So I'll show you the chart. Sometimes the move happens intraday down and then it reverses sharply. So this is very like be very careful when the intraday penetration is happening of a 50-day moving average. The stock can sharply bounce back up and you can get caught. So ANF is just on my radar. Another one is BA. So they on CNBC they were talking about BA, that the BA may have lost its steam and it can come down. So if you see this doji, so whenever this kind of, when you draw this trend line, I'll show you the NVDA chart, similar, same pattern. So it doesn't matter if it's a BA, NVDA, or Netflix. If the stock is giving you the same pattern, then you know what can happen. So this is the resistance line. If you draw, this is the doji. So this doji said BA exhausted, and then it crashed 3 days. It pulled back. Now it's at the support level right here. If I draw this trend line, this is support. So if it's a support, so what I'm going to do, and especially there is a support under the support. So when there is a support under the support, it's very good. So the support, this is the support, and then there's another support line, a 50-day moving average. So BA is sitting at the support level. So if the BA starts moving up aggressively on Monday and Tuesday, I go long. Otherwise, I know it can come down. 331 is the 50-day moving average. It can also break below 50-day and then intraday, and then it reverses sharply to the upside. If that happens, there's another indication of going long. So this is radar. All right. Now CVX also, you see CVX is sitting on the 200-day moving average, and this is the support line. So now I know, okay, CVX is sitting at the support line of 110. So what it will do next? But it is bearish because if I remove this line from here, is sitting at below 200-day moving average, which is bearish. So recently we traded calls, we made money on the way up. Now it's trying to penetrate the 200-day moving average, but it's failing. So if it fails and break this line, we should go short, but we have to know that this is the support right here. 107.50 is the support area. So this is again is on my watch list. Another one is LYB. So LYB is also, you see how it's facing the resistance. So if I draw this trend line touching all these candles, at least need to touch 3 candles, and here is the resistance. So it's facing the resistance at 107 level. So now what I do, I just put it on my watch list. If this LYB starts moving down, I know that this is the support at 102 level. If it's sharply moving, then I will go short on it. Otherwise, just ignore it. So again, this is on my watch list. Next one is Nike. So Nike moved back 3 days, but this was it's bouncing here from this support line and is trying to conquer the 50-day moving average. So if Nike starts moving up, then this is considered as a long candidate. So I have it on my watch list for a long candidate. So I'll just watch it during the day and see what happens. If it starts moving up, I know where it is. 64 is the support right here. This is the support area, and I will just go long. So it's again on my watch list. DKS is also on my watch list for long. So this is the support line, and this was a bullish candle. DKS is also trying to conquer 50-day moving and 200-day moving average. So if it starts moving up, I go long. Otherwise, just ignore it. So just on the watch list based on all this criteria. Another one is EQIX. So it's really bearish, really bearish. This is the downward sloping line. So it's sitting at 381. So I know that this is the support, 381. So what it will do next, if it starts trending lower, I go short. Otherwise, I just ignore it because it has too much resistance to the upside. The chart is really bearish. So I'll just look for the entry to the downside. Again, it's on my watch list. OXY. So OXY is also on my watch list. It's right now it's sitting on 200-day moving average, right? So what it will do, 200-day is considered as support, but the support is broken. If all the crude stocks are coming down on Monday, Tuesday, OXY could be one of them. So OXY, CVX, there are others. So I would go short. Otherwise, just ignore it, knowing that 64.57 is the 200-day moving average. All right, is a support. So if it's support, it can hold. But if it breaks, then really bearish. So if the stock is trading below 200-day moving average, is considered bearish. If it's above 50-day moving average, is bullish. If it's between 50-day and 200 days in La La Land. So right now it's sitting at 200-day. If it breaks, okay, go short. Another one is PKG. Again, PKG, it is this is still bearish. It's kind of hammer, but it's not at the proper location. So it's trending down. So in case if PKG starts pulling back, I know 113 is the target. This 113.62, and it's trading at 117. So there's a 4-point potential in it here. So I just watch it, keep it on my radar, and if I see it's coming down, I just and get out at 114. So it's on my radar. Twitter. So Twitter, I went long on Friday, and this is the reason. So after sideways move, I explained to you before also when it gapped up on earning, the sideways move on Friday, it showed the bullishness. So when the stock makes this kind of bullish move, especially you have to coincide with the NASDAQ. So I'll show you the chart of NASDAQ and the levels of support and resistance. So when the stock is trading like that, I say, okay, it's better. My probability, I'm stacking my probability. So the probability is high that the Twitter will move to the upside. So I go long. So I went long. So this, and my target is 35 plus right here. So if I extend this line, my target is 35 plus. UNP is also long. So here is the rising support line, and it's bouncing from it. So in case in case UNP start moving up, I go long. So again, this is on my watch list. So I prepared these charts based on the watch list I have, and I'm showing you. So this is exactly what I will do on Monday. I have already set it up on my watch list, and I see which one is moving up, which one moving down. If all these stocks do the opposite of what I thought it will do, it's still okay to watch for 2-3 days, because the stock initially do the opposite of what you are thinking, and then it does the same thing what you thought it will do. So it's prudent to keep watching it for a while till you are completely sure, okay, it's no more valid. So this radar watch list, I watch it for 2-3 days, and in that watch list I keep adding new stock every day. I keep adding. Some get subtracted, some get added, and then the list builds up, and then the list dies on Friday. The list is finished. Then on weekend I prepare a new watch list, and then I keep building it on Monday, Tuesday, Wednesday, Thursday, Friday, and then the list dies on Friday. Weekend. On weekend I just keep like some stocks from the Friday list. Some goes back, but I go thoroughly and review all of them and make a fresh list. VMW. So VMW gap down. So you see the gap down. So now this is the support, right? So it's closed at 116. So again, this is on my watch list. It's at 110. I like 110, 111 level. So I know this is the support area, 200-day moving average coinciding with this trend line. So I just put it on my watch list at 110. If it's bounces from 110, I will go long. Otherwise, I just leave it alone. Just leave it alone. It's on my watch list. FDX is, for me is short, and I'm just waiting for it to break this line. So this is actually support, consider support. So if it breaks the support, here is this hammer, 225 level, 225, 226 is my target. So you can watch FDX is bearish, and looks like it will break this line going down towards 225.26. So just keep it on the watch list. Next is DRI. So DRI came on my radar on 1st of March, which was Thursday. The market was bearish. I did buy some shares. I did not send any alert because of the market conditions. So I said, okay, I'll buy because of this bullish move. And it happened that I made money. So, but the market was bearish, so I did not send this alert. I sent another alert on Kellogg. So we made money on that. So one trade was enough because Thursday was bearish day. So this candle, you see this, it took over, conquered this bearish candle. So this was a bullish setup. So I said, okay, something going on. So I buy a few shares. And this is what happened next day. Friday got out, support bullish candle. It may continue to go up. So that's it. Kellogg. Now Kellogg. So what I saw Kellogg, I said, okay, what are the probability of me losing money on Kellogg on Thursday? So I sent alert on Thursday to buy calls, and I bought calls. So here is this bearish candle, right? Breaking the 200-day moving average. But next day, why the stock gapped up? If the stock gap up where it penetrated 200-day moving average, super bearish, these two candles, and it gapped up, something has changed. So I said, okay, what are my risks? The risk is that the stock comes down again at 200-day moving average. So I sent alert. I said, okay, we buy calls on Kellogg. So we bought calls on Kellogg. Friday it moved up. So this was it. There's no indicator. You see any indicator? I'm not hiding any indicator. There's no indicator. I don't use any indicator. So here it is. Boom, go up, went up, lot $120 per contract. So this is the example. This is the kind of trade we need. Immediate move next day. When the move comes next day or 2 days, the return is very high. So the return is high when the stock moves fast in our direction. Yeah, this is KSS. So KSS was moving down on earnings. So I was watching it Thursday, and it was penetrating the 50-day moving average. But because we know that intraday the stock can penetrate the 50-day moving average or 200-day moving average, and then the buyer comes in and they just hold it and reverse the stock. So you say, okay, this is really bearish, right? This candle, but you have to see where this candle is forming. It's forming at 50-day moving average, so you have to know that anything can happen. So next day, what happened? Complete reversal to the upside. Now this is the breakout reversal. So this is where KSS is expected to move and make a new high. So you see how the position changed, looking super bearish, this candle, and now looking bullish. Change, right? So intraday, 50-day moving average break, right? If you are watching this, you say, okay, I'm gonna go short. I almost pulled the trigger. I said, okay, if it goes little more, then I will go short. So, and it was 9:55 a.m. Pacific. But I said, no, I need to watch. It needs to go down way below that. It's hard for it to come back above 50 days. So I did not pull the trigger. I said, okay, I wait. And then it bounce up, the next day confirmation. So KSS, if it breaks this, it's going up. It's making new high. This is the resistance, near 68. It will go higher. Next is WBA. WBA is taking its time to go long, but it is long. It's bouncing. This is the trend line. It keeps bouncing. On Thursday, in the market was bearish, but it was going up. So once it clears this area, it's expected to go towards 50-day, and then 74.87 is the 200-day resistance. Last, I think this is last, US Steel. So US steel moving up because of tariff, etc. So this is the resistance line on Thursday, 46.41, and it's just is hanging here below resistance. So what will happen? It will poke its nose, try to break it, and then finally it will break it and go towards 50. So X is going towards 50. The VRX. So VRX is sitting at 200-day moving average on 28th of February, right? So at 200-day moving average. So you would say, okay, this is support. I cannot go long when the stock is sitting at support, and you should not, because it can hold. But what happened? It broke the 200-day moving average. So now just watch. Candle is still bearish, and the reason it is bearish is that it tried to move up, but it did not penetrate the previous bearish candle. So it was supposed to go above this blue line. It was supposed to close right here around near 16, 15, 50, 1575. So this is a bearish candle. The bullish move, the buyers were in a little bit, but not powerful. So it's still bearish. So it can still roll down to the downside. So it rolled down. If it not, then I'll just leave it alone. I don't care, right? So the stock has to tell me. Qualcomm, we traded Qualcomm and made money, gapped up, and yeah, gapped up. So we got in somewhere here and got out. I don't know the exact. I think we got out right here. Now it reversed. So I kept telling you about Qualcomm that it has a strong resistance of 68. I've been showing you this resistance for a while, since here, and it's unable to penetrate 68 level because of the strong resistance right here. Too many sellers. So it broke the 50-day moving average on Friday, and this window is open. So this window is open. It can come down to close this window. So Qualcomm right now is a short candidate. Is sitting below 50-day moving average, unless it moves sharply and goes above 50 days, so that it will what is called void our thesis of short. UPS. So UPS is sitting at the strong support at 105, 106, 107. So UPS is expected to move up. This is all the support. This is what the stock is saying, that I'm at the support at 105. I have buyers. So UPS is expected to move up. Okay, this is 26th of February chart. Sorry, this is old. Let me see. 1st of March. So this is 26th of February. So it's sitting at 107 and it's sitting at 106.64. So it's still, you see how it's sitting at support. So it's unable to go down. It's not going up. So eventually it's expected to move up. Next is NVDA. I'll show you the chart. I showed you the chart on 21st of February. We went short because of this doji candle. And we said NVDA has topped out at 250 again, and we need to go short. And it tanked. So I show you the chart. And I showed you last week also that NVDA is supposed to go down. So it did this. Then it started tanking. And then 50-day moving average. So this is where we sold. 50-day moving average is considered to be support. The buyers can always come in. If you are short, you have to, and the stock is approaching 50-day moving average, you have to watch right at the open. So this was the stock which we needed to watch right at the open. So we made 700 per contract profit twice in 2 different strikes. So NVDA can reverse to the upside. 50-day moving average is the strong support. Next is Netflix. So I showed you the chart of Netflix that is supposed to go up. So someone sent me email saying, Seeking Alpha is saying that Netflix should go down because of tax plan. So why we are going long? So I don't know about Seeking Alpha article. So I know the Netflix is supposed to go up. So it went up. See, it was consolidating at the high, and then Netflix went up. So this is what it did next. And on Friday, it moved aggressively. And the reason it moved, it coincided with the NASDAQ. So if you look at this stock is at NASDAQ. And I'll show you the chart. NASDAQ gave another buy signal on Friday, intraday, and Netflix move up aggressively. So once it crosses this 301, 302 level, Netflix is going towards 310, 312. So another 10 points is coming in Netflix. So this move is not over yet. So this is the example of a breakout. So Netflix is breaking out towards 310, 312. Okay, so last 4 charts left. Okay, so this is Dow Jones of March chart. So March 2nd, Friday. So Dow Jones just hit this support. So I'll give you the example. I'll give you the levels of resistance. So I'm showing you the support. So you need to know both, right? The support and the resistance. So the stock market can bounce from the support, but then it hits the resistance and then it comes down. Then it comes down to the support, then it bounces up, then it hit the resistance. So you have to be aware where the resistance levels are. So what you should be watching. So this is the support level. This was the entry. This was the first entry, early entry for us. And this was the entry intraday for long. And then 4 days of pullback. So this was intraday again, a little buy signal on Dow Jones from support. So you see, earlier the support was here, right? But this is a rising trend line. So the support is getting higher and higher. So support is getting, so if you were watching support at here or here, it came early. So it came here. Next is SPX. So if you look at SPX chart, it's 2650. You don't see anything on the chart, but it doesn't mean, what you have to do, if you cannot find the support and resistance on one chart clearly, you have to switch to another index and see what they are telling you. So another index is telling you something else. So you pay attention to that. So NASDAQ was telling us that its market is bullish. So this is a super bullish candle. And the reason is it bounced from 50-day moving average, from 20-day moving average. And this candle went below the low of this previous, but it closed midpoint of the previous. So all the buyers are in. So NASDAQ is super bullish now. The buyers are in. So this is the candle. This is the market you need to pay attention. NASDAQ. Last is the Russell. So Russell also bounced from the support of 1500 plus resistance at this level. So I'll give you the exact figures of resistance so you can write it down in the next slide. So these are the support and resistance levels. So NASDAQ 100 bounced from support of 67.89. It closed above. It closed at 68.11. So in other words, this was the support. So it went below and then it closed above. So this gave us the signal for going long on NASDAQ. S&P has a resistance at 27.40, which I mentioned earlier also. And that resistance is still valid, and it closed at 26.91. So we have about 49 points in S&P resistance above. Dow Jones resistance is at 25,116. It closed at 24,538. So it has 600-700 points above. So this is far resistance level. Russell 2000's resistance is at 1537. Show you 1537. So Russell 2000, this is the resistance level. So 1537 is the resistance level. So in out of 4, NASDAQ is trading above the support and is bullish. The other 3 indices are trading below the resistance. So this is considered bearish. So we have a mixed market. So when we have a mixed market, that's what happens. The market is choppy. One day it goes up, one day it goes down. Unless all out of 4, at least 3 indices conquer the resistance level, then the market becomes bullish. So just watch these 4 markets. One is above the support and 3 are below resistance. Once another 2 markets conquer the resistance, then the market will become bullish. So the first one to watch is Russell, because Russell is very close to the resistance. So the market to watch is the one which is very close to the resistance. See what happened. Russell closed at 1533 and the resistance is 1537. So only 4 points. So 4 points plus 5, 6 points, like 10 points above. So 1547, 1550. If you see Russell 2000 crossing 1550, okay, there's another signal of going long. So just stack it accordingly, one by one. All right, so this was my last slide, and it's 6:17. And again, dollar offer for 2 weeks. If you're interested, send me email and I'll send you the offer. And I have a 60-minute strategy session, 6-month coaching program. This could be 9-month also. What it is about. Thank minutes. Next webinar will be on next PM, and I will cover another topic and some stocks. So do come, and thank you for coming. And you will receive about my offer of $17. So try it and see if you like. See if I can help some money and educate you.